15 to 1. That's the kind of ratio that can break a market. 15 paper claims for every 1 ounce that can realistically be delivered when everyone rushes the exit at the same time. Now imagine this. It's the open of the US session, silver is surging toward $98, and suddenly trading doesn't just slow down, it stops. Screens hold a number that looks official, orderly, contained, while the real-world market keeps moving. Today's episode is not about hype, it's about structure, because when a market freezes near a psychologically explosive level like $98 on the way to 100, the bigger story isn't the price. The bigger story is, can the system settle what it promised? When traders talk about a halt, most people assume it's a technical hiccup, like a website crashing because too many people logged in. But in futures markets, a trading halt is often something else entirely, a pressure release valve that's triggered when price moves too far, too fast. And here's the tension. In precious metals, especially silver, fast price moves are rarely just emotion. They often expose stress in 3 places at once. Liquidity disappears, market makers widen spreads or step away. Delivery demand rises, people want metal, not exposure. And margin requirements jump, short positions get squeezed by collateral calls. When those 3 happen together, you can get a situation where the paper market looks calm on a frozen screen, while the real-world market trades like a storm. And if you've ever wondered why people say, own the asset, not the promise, this is the kind of day they're talking about. Step 1. What a limit halt actually is. Exchanges use price limits and circuit breakers to prevent chaotic trading. If a contract hits its daily move limit or triggers volatility controls, the exchange can pause matching orders. In plain English, the market doesn't stop because it's broken. It stops because continuing could become impossible to manage. That sounds protective, but there's a second function that matters just as much. A halt can also buy time for the clearing system, time to reprice risk, demand more margin, and stop a domino effect. Step 2. What you're trading in silver futures. A silver futures contract is a standardized agreement that references silver. Some contracts can be settled with delivery. Many participants, however, don't want delivery. They want price exposure. So the market becomes a giant intersection of hedgers, miners, manufacturers, speculators, funds, traders, and intermediaries, banks, market makers. Most of the time, this works. The contracts are rolled, closed, netted, and settled in cash differences, until delivery becomes the point. Step 3. Why paper silver can detach from physical silver. Here's the simplest way to understand it. Paper silver is a financial instrument with rules, margin, settlement procedures, and crucially, the option to cash settle in many real-world scenarios. Physical silver is metal that must be sourced, refined, assayed, shipped, insured, and stored. Those are not the same product. When markets are calm, the prices track closely. When markets are stressed, the physical side starts pricing in scarcity, delays, and risk. That's when you see higher dealer premiums, longer delivery times, and spot price that feels increasingly theoretical. Cause A, a delivery surprise. Futures markets operate smoothly partly because most participants don't request delivery. But if the buyer mix changes, if more industrial users or large allocators decide they want metal, then the system is asked to do something it rarely does at scale: delivery. Effect, warehouses and approved inventories become central, and everyone begins watching how much registered supply is actually available versus how many claims exist. Cause B, liquidity withdrawal by market makers. Market makers provide bids and offers. When volatility spikes, they protect themselves by widening spreads or stepping back. Effect, with fewer sellers willing to quote, price can gap upward quickly and volatility controls can trigger. Cause C, margin calls create forced behavior. If you're short silver and the price rises sharply, your broker or clearing firm demands more collateral. If you can't post collateral, your position may be closed, sometimes at the worst possible time. That forced covering can accelerate a rally, which triggers more margin calls, which accelerates the rally again. That feedback loop is how orderly markets become disorderly. Most viewers focus on, will silver hit $100? Professionals ask a different question. If price spikes, can everyone settle cleanly without rule changes? Because when stress hits, a contract is only as good as a system that enforces it, and the system is only as strong as its weakest major counterparty. And this is where people throw around big phrases like systemic risk, but the real meaning is simple. If a few large players are too exposed on one side of the market, their survival can become more important than contract purity. And history shows that when stability is threatened, exchanges and regulators will prioritize the system over individual outcomes. Think of it like a concert with 100 seats but 1,500 tickets sold. Most nights, it's fine because many ticket holders don't show up. They bought tickets to resell or as a gift or just in case. But if word spreads that tonight's show is legendary and everyone decides to attend, the venue has two choices: admit the math doesn't work and face chaos, or pause the line, renegotiate, refund, and control the crowd. A silver market freeze is the financial version of the venue realizing too many people just tried to enter at once. Silver is not just a precious metal story, it's a dual identity asset: industrial input, electronics, solar, medical, EV infrastructure; monetary hedge, insurance against currency debasement and systemic stress. That dual identity makes silver uniquely sensitive to macro forces. Trend 1. Electrification is silver intensive. Even without making any dramatic predictions, the direction is clear. More power grids, more devices, more electrification, more solar deployment. Silver is used because it's highly conductive and reliable. If industrial demand remains firm while new supply slows to respond, the physical market tightens. Trend 2. Mining supply does not respond quickly. Markets love to say high prices solve high prices. In mining, that's only partially true. New production takes years: permitting, financing, development, refining capacity. Even reopening a shuttered operation takes time and capital. So price can run ahead of supply for longer than people expect, especially if demand remains steady. Trend 3. Monetary uncertainty keeps precious metals relevant. In a world of high sovereign debt, persistent deficits, and periodic liquidity interventions, a portion of investors will continue allocating to tangible assets, sometimes quietly, sometimes aggressively. Silver, because it's smaller than gold as a market, can react more violently when flows increase. Trend 4. Geopolitics and supply chains matter again. Refining concentration, shipping routes, and domestic prioritization can all tighten supply without any formal ban. Even small frictions, export paperwork delays, insurance cost spikes, refinery downtime, can push physical premiums higher. Let's talk opportunities, but responsibly. A market stress event can create temporary mispricings and information advantages for people who stay calm. Here are realistic upsides to understand. Opportunity 1. Better awareness of what you actually own. If you only hold products that track paper price, this is a moment to evaluate: what are the settlement terms? What happens in extraordinary circumstances? Do you have direct claim to metal or exposure through layers? This isn't fear-mongering, it's basic due diligence. Opportunity 2. Volatility creates entry points if you avoid leverage. When markets gap, they often overshoot both directions. Patient buyers sometimes get opportunities during forced liquidations. But the key word is patient and unleveraged. Opportunity 3. Industrial and strategic demand can support longer-term pricing. If demand is structurally supported, not just speculative, then dips may be bought faster than in a purely hype-driven rally. That changes the rhythm of corrections. Now the part most people skip, and the part that matters most. Risk 1. Leverage can wipe you out in hours. Silver is historically volatile. If you're trading leveraged futures, options, or CFDs, a sharp move can trigger margin calls fast. And the worst moment to need liquidity is when everyone needs liquidity. Risk 2. Counterparty risk is real in paper products. Ask yourself, who owes you what? Through which chain? Under what conditions can terms change? If settlement rules allow cash settlement when delivery is disrupted, then your silver exposure might become currency exposure right when you wanted metal. Risk 3. Forced cash settlement or rule changes. Most people assume contracts are ironclad until they learn about emergency powers, exchange discretion, and clauses that allow altered settlement in extreme conditions. It's not that the market is rigged, it's that the market is designed to survive. And survival sometimes means changing outcomes. Risk 4. Physical has its own risks. Physical metal has storage and insurance costs, dealer spreads, authenticity concerns, and liquidity constraints during panic. Owning metal isn't magic, it's just different trade-offs. If you want to follow this intelligently, here are concrete indicators professionals watch: exchange inventory reports, registered versus eligible categories; lease rates and forward spreads, signals of tightness; physical premiums and delivery times from multiple dealers, not just one; volatility and margin requirement updates from clearing firms; Relative pricing across regions. Are gaps widening or closing? CFTC positioning data. Broad changes in managed money versus commercials. None of these are perfect alone. Together, they tell a story. Here are 4 grounded steps you can take. No hype, no guarantees. Takeaway 1. Map your exposure, paper versus physical. Write down what you own and what it actually represents. ETF, allocated metal, unallocated account, futures, mining equities. And then read the settlement and redemption terms. Takeaway 2. Avoid leverage in high volatile metals unless you're a professional risk manager. If you must trade, size positions assuming the market can gap against you and you may not get perfect execution. Takeaway 3. Use staggered entries and keep liquidity reserves. Instead of all-in, consider phased eyeing or phased hedging. Liquidity is a weapon during volatility. Takeaway 4. Track real-world tightness, not just a screen price. Premiums, delivery delays, and spread behavior often reveal more than the headline spot quote during stress. If you want to verify claims and build your own view, use primary and reputable sources. Exchange rulebooks and notices, halt rules, margin changes, public inventory reports from major venues, CFTC market data and positioning reports, BIS data for derivatives context, IEA/USGS for industrial demand and supply chain research, reputable financial press for confirmed developments. The goal isn't to believe a narrative. The goal is to understand the plumbing, because when plumbing fails, headlines arrive late. If silver approaches a level like $98 and the market pauses, don't treat it like entertainment. Treat it like a stress test. A halt is the market admitting, we need time to measure the damage. And when trading returns, the real question won't be whether silver prints $100. The real question will be, did the market reopen with trust intact? Or did it reopen with new rules, wider gaps, and more people realizing they were holding a promise instead of a thing? Because in a crisis, price is just the headline. Settlement is the story. This video is for educational and informational purposes only. It's not financial advice, and it's not a recommendation to buy or sell any asset. Precious metals and derivatives can be highly volatile, and you can lose money, especially when using leverage. Always do your own research and consider speaking with a licensed financial professional.